line in. I'm not saying, hey, is it variable cost for cost of goods sold? Is it part of inventory? I'm just looking for all variable costs because they behave in a similar fashion. For managerial accounting, that's very important because it helps us to, measure things a lot more easily. So variable costs are going to include direct materials, and we can indent that by going to the Home tab, alignment, indent, going to K4 equals direct materials. And then we have direct wages, which is direct labor. And so we're going to click on that. We're going to go here. We're going to go to the alignment, indent that. And I'm going to say that equals this item. And we could then highlight those two items and say, okay, we found a home for those. We're converting it from yellow back to blue when we find a home for these now. And then we have the sales commission. So this is a difference. Okay, with the sales commission, it's going to go up here, not because it's part of inventory. That's a sales item, obviously. But I'm going to go to the Home tab, alignment, but it is variable. It changes with production in a similar way. So we want to group those by the behavior of the cost, not what the cost is doing in terms of production, inventory, or in sales. So this is the difference, and that's why we need these two statements for different purposes. So we got the font underline, and that's going to be our calculation there, and that'll give us the total variable costs. So I'm going to say total variable costs, and I'm going to go ahead and indent that, Home tab, alignment, indent, like so, and then we're going to go and sum that up in the outer column. L7 equals the sum of these items here, and we have the 370, 800. Now, if we wanted to check these, I can highlight this and say, okay, does that make sense? This adds up to 730, 800. Yes, it looks correct. All right, and then we're going to calculate what's called the contribution margin. Nothing else. Okay. And we're going to sum that. So this is the major number we're going to use oftentimes. So we're going to take the sales minus the variable cost. That gives us the contribution margin. Again, this isn't financial accounting, financial statements. You're not going to see this generally on financial statements. This is a managerial type report. Contribution margin being very important for many types of internal decisions. Then we're going to break out the fixed cost, the costs that act differently in terms of being fixed as opposed to variable. And we're going to say those are that. And we're going to find the fixed costs. We got taxes on the factory. We're going to assume those taxes, like maybe property taxes or something like that, are going to be pretty fixed, the same. So we're going to say, okay, let's indent that. We're going to bring that to the inside and say that equals to 13.5. And then I'm going to go back over here, highlight that, and make that blue. Found a home for it. We got the maintenance on the factory. It says that that's fixed, so we're going to have that. I'm going to say that that equals to 27,000. I'm going to right-click on that and make that blue as well. And we could indent that to Home tab, alignment, indent. All right, then we've got the depreciation on the factory. So that equals the depreciation on the factory. So I'm going to hit that, Home tab, factory equipment, I should say. And that equals the 87,000. So we're going to click on that. Of course, depreciation doesn't change with the level of production generally. And then we've got the lease on factory equipment. So again, the equipment lease, we're saying that that's going to be the same. It's not going to change no matter how many stuff we have to produce. We still have to pay the kind of the rent on the equipment. 27. And then we have the administrative salaries. So again, we're jumping from the factory and producing stuff to administrative stuff over here. But the administrative stuff, they're salaries. So anything that says salary means that it's fixed. So it doesn't matter how much stuff we produce, it's fixed. So we need to think about it when we budget and plan and whatnot as the fact that it will not change with the level of production. Rent on administrative office, same thing. The rent on the administrative office, not going to change. When we have other things, the level of production changes. So we're going to say that's the 50, and we're going to highlight that. And then we've got the rent on the sales office. So we're going to take that. We're going to go to the Home tab, alignment, indent, and we're going to say that equals the 77. And that will finally give us the total. So I'm going to go back over here, going to Home tab, I'm going to underline that. Then I'm going to go down here and say this is total fixed costs. Enter. I'm going to indent that a couple times. Home tab, alignment, indent 2 times. Then we're going to go over here in the outer column, L17 equals the sum of. We're going to highlight 13.5 down to the 77,000 and enter. And that will give us the total fixed costs. I'm going to highlight this. We found a home for that too. So we got that. And we only have the tax that we have to relate to. And we'll break that out separate as we did before. So we have the income before tax. Before income tax. And that's going to equal the contribution margin. That's what we left off last time, minus the fixed cost. That's what we have before the income tax at this point. Then we're going to have the income tax. So income tax, again, a lot of problems might just say, hey, calculate the income tax. We're going to tell you what the rate is, anywhere between 30 and 40% oftentimes. And in this case, we have it in the trial balance so that we can tie out to the ending number in the trial balance here, which is going to be net income. And then we finally have the net income. So net income then equals, actually I shouldn't have underlined this. I'm going to ununderline that. And it should be underlined here. We're going to underline that. And then we're going to go here and we're going to go to the home tab and underline that. And then we're going to say that the net income then is the income before income tax minus the income tax, giving us the net income. So the point is, if we unhide this, I'm going to highlight from C to J, let go, right click, unhide. Now we can see the difference. So the point of this is that we're taking this information from the same information. The same kind of trial balance can be formatted in different forms, just like a jigsaw puzzle. The contribution margin income statement is just taking that same information that we could compile an income statement in and putting it in a different format. That format not being broken out by basically the cost of the goods sold, the cost of the inventory, but rather being broken out by behavior of the information, behavior of the expenses. Okay, so last thing we could take a look at is the contribution margin per unit. Contribution margin per unit. All right, so in order to calculate this, I'm going to take the sales, and we're looking at the sales price, basically sales per unit. And the sales per unit will be, if we scroll back over to the information, we're saying units produced 4350 and sales price per unit. They gave us sales price per unit 285. So 285 is going to be the sales price per unit. So we're going to go back over here. Sales price per unit 285, and then we're going to have the variable costs per unit and colon. And so the variable costs are going to be these items here divided by the number of units. So the number of units, if I scroll back over here, is going to be the 4350. So 4350 is the number of units. So I'm going to take then the direct materials here, and we can indent that, home tab and alignment indent, and we're going to take this number, the $247,950 in dollars, and divide it by the 4350. So I'm going to take that divided by the 4350. I'm going to write that over here, 4350. All right. So that's how many units we have. Okay, so then we're going to do the same for direct wages. Direct wages is here. We're going to go to the home tab. We're going to go to the alignment indent, and we're going to go to 05 equals the 387,150 divided by 4350 gives us the 89 direct wages per unit. Then we've got the sales commission here. Going to go here. Going to go to the home tab, alignment indent, and we're going to take the total equals the 95.7 over the 4350 units. That's the sales commission per unit. We can then go here, home tab. We can go to the font underline, and that's going to give us the total variable cost per unit. All right, total variable cost per unit. I'm going to go to the home tab and indent that 2 times. And then we're going to go into the outer column. I'm going to sum this up equals the sum of just this column. We only do one column at a time. I'm not going to jump back and forth. 57, 89, and 22, giving us the 168. Then I'm going to go home tab. Going to go to the font and underline. And that will give us the contribution margin per unit. The very thing that we were looking to get. So that's going to equal the sales price per unit minus the contribution margin minus the variable cost per unit. So this is sales per unit, let's say. So we got the sales per unit minus the contribution margin per unit. Now that's going to be really important when we think about projections, because now we can think about, oh, so that's how much we're getting basically after just the variable costs, which act in a similar way as sales. And so now we can think about how many units we need to sell in order to clear the fixed costs, which we'll talk about later. So we can think about, okay, so how many units, if I multiply that times how many units do I have to sell in order to clear the fixed cost, which in this case is $388,500. So if I wanted to kind of break even before income taxes, we'd have to say, okay, well, fixed cost is $388,500, and we're getting 117 after variable cost per unit sold. Therefore, the break even would be this divided by this if I didn't have to pay taxes. And so we'd have to sell 3,321 units, right? So we can do it becomes very interesting to make calculations on that. Now, the next thing that becomes important is the contribution margin ratio. So we're gonna, in order to get the contribution margin ratio, what we would do is compare the contribution margin to the sales, meaning it's a division problem, so ratio. So we're going to say, okay, we're going to take the 117, that's what we're walking away with, divided by the sales price, and that would give us the contribution margin ratio, which I've already made a percentage. We've formatted this by going to the Home tab, Alignment, and making it a percentage. 41% or 0.41 would be the contribution margin ratio. So basically, we're walking away on just after variable costs with 41 cents on the dollar of sales. Now, we can clearly do that as well with the total variable cost. We can say, okay, well, what's the other piece of that? Well, it's the variable cost as a proportion to sales. So if we took the variable cost of 168 as a proportion to sales, we would then get the 59 plus 41 being the 100. So every dollar sales, we have 59 in variable costs and 41 being what we would walk away with if we didn't have to cover the fixed costs. Now notice we could do that. We can do the same type of thing if we were to do the contribution margin here divided by the total sales. So if I was to do that, for example, if I took the contribution margin over total sales, and I was to go to the Home tab and the Alignment and make it a percentage, we would get the same 21%, right? And the reason is because because of the behavior of the variable costs and the fact that they will go up in a similar fashion as the sales. So that's why that's important. Now, what will not happen, of course, is if we took the net income and compared it to the total sales as we had different production volumes. That doesn't work. So that's why we need to break out between variable costs and fixed costs to help with certain types of decisions and projections going into the future.